Wij gaan door met de volgende presentatie, de laatste, en die is van April LaRusse van Insight Investment, wat gedistribueerd wordt door Bank of New York Mellon. En zij hebben een klimaatrisikomodel ontwikkeld waar ons over gaan inlichten. Nou, dan wacht ik daar even op. Hi, April.
Hello, good afternoon.
Hi, can you hear us?
Yes, I can.
Excellent. Okay, welcome to the Pensioen BeleggersBeraad in Amsterdam. You'll be guiding us through the climate risk model that has been developed by Insight Investment.
Yes,
That's
I will.
right. Okay, we're looking forward very much. There's one question I should ask you beforehand. Would you like to take questions during your talk, or would you like to take them in the few minutes at the end of your talk?
I think at the end will probably be logistically easier.
Sure. Okay, then the floor is yours.
Wonderful. Hopefully my slides will appear so the audience can see them. But I will start just talking about what we're seeing in the institutional client space with regard to climate. I'm sure that the audience is having the same types of questions from their end user clients about what are you doing in my portfolio to minimize climate risk or even to understand it, and how are you able to report to me in a way that is more meaningful for being able to consolidate different investments, but also being able to monitor and track what carbon emissions look like. And basically the first slide, when I was thinking about what to say on this talk, honestly, the information that we are seeing on carbon makes me really understand why the focus from clients has been very much on, of course, all things ESG, but wanting specifically to see what's happening from a greenhouse gas emissions perspective. And rather pessimistically, I was reading some research which suggested we only have a 50-50 chance of achieving that wonderful 1.5 degree of warming. But that would require a 45% reduction in carbon emissions relative to 2010 levels. So that's actually, essentially, if you look at all the government pledges which have been put on the table so far, and maybe we'll have some more at the Glasgow summit, the COP summit, which is happening at the end of October. But where we stand now, the government pledges only amount to a 16%, or will actually amount to a further increase in emissions by 16% by 2030. So actually, we're very much moving in the wrong direction when it comes to emissions. Now, of course, investments in renewables definitely helps, and of course, the energy sector are the single biggest investor in renewables. But of course, even the renewables as a function of overall contribution to energy is really only covering the growth that we're seeing in the demand for energy. And so I did find a chart which is showing, all different types of energy generation. And unfortunately, you can see the renewables are just the very thin stripes on the graph on the right-hand side. So clearly, we need to do a couple of things. There's a requirement to get the businesses we invest in to reduce their carbon emissions in terms of transitioning their businesses, but there's also a requirement to focus on new technologies. And in fact, the IGCC report, which came out a few months ago, said that we won't be able to actually achieve the 1.5 degree goal unless there is a focus on increasing the investment in new technologies. Direct air carbon capture is the one that most people are thinking about. So it really, in order to tackle the problem, you can't just reduce emissions. And of course, we're also speaking to companies about to what degree they're able to spend some R&D money, some CapEx on these new technologies. So in terms of what we're seeing in fixed income markets, there are forces from all three sides, and you can see this on the next slide, that are really pushing us all down the same route. So much so that when you think about how asset managers are set up, I can really imagine a world where there isn't a requirement to have a separate RI team, because responsible investment, ESG, and climate risk are part of the normal investment process anyway. So why would there be a completely separate team to do that sort of thing? In terms of the forces that are driving all asset managers and how they think about their investment processes, clearly there are big political forces at work here. Obviously, the COP summit, which I mentioned earlier. We have seen that with things like the Green New Deal in the UK, but also the European Recovery Fund, essentially saying they're going to spend something like 38% of all of the financing, which has been agreed to on green projects in Europe. Of course, there's been many different countries coming out and saying they're committed to carbon neutrality. So Denmark, France, New Zealand, the UK, Sweden, Japan, South Korea, to name just a few, actually enshrined it in law. And then what's also interesting is central banks are out there stress testing their banking systems and insurance companies for climate risk. And that is something that's new, and clearly it will impact how banks are thinking about who their ultimate clients are and who they're comfortable lending to. The other thing, which of course I know the people in the audience will have seen this, is an increased demand for ESG and impact strategies. So you can see that in any of the fund flow data. Well, it's a very clear trend, and clearly that has impact for what sectors outperform and underperform. Of course, there's also a regulatory push for more transparency, so the European taxonomy, and of course SFDR, and in the UK TCFD, just to name a few of these acronyms, which all stacks up to the same thing, increased regulatory disclosure. And then the other thing that's been quite gratifying to see is that the impact bond sector has continued to broaden out, different types of issuers coming to market, and also an increased amount of issuance in bonds that are sustainability linked. So all of those things are telling us that the ESG trends in fixed income markets will continue. In terms of our climate risk model, and something that, the journey that we took in developing this in order to do our credit analysis, clearly developing a climate risk model was very high on the agenda after developing our prime ESG scores, because of course we could see very clearly that many companies in all different sectors were very exposed to changing climate regulation. The other thing, of course, we could see is that even their end customers, if a business seemed to be slow, there was definitely a backlash from end users about how that business was actually behaving and what was it doing about climate risk. We've had many questions from our institutional client base about stranded assets and to what degree, the bond that we bought for them is actually going to be money good if we're looking at a long-term bond, and perhaps there are some assets there which may not have as much value as we had thought several years ago. And then, of course, the weather, especially this summer, it's been one climate-related weather event after the other. So there are questions about how much actual physical risk is in these assets. In terms of sort of pulling together the data to make our climate risk model and ultimately our climate scores, when you look across at different asset managers and different entities who are producing climate risk information, there's really no set agreement on who is the best place to source your data from. So we had a look around all the investment managers out there doing climate risk analysis. And what we noticed is that really we're all choosing slightly different providers for data. And the data is coming in two different ways. You can use raw data sources where, frankly, they're just giving you the numbers. So the ultimate climate carbon number is being produced by various companies. And of course, there are also data providers out there who are putting their own spin on it or making extrapolations or assumptions using that data. And so really what we find is that most asset managers and other institutions making these types of risk assessments are choosing different types of data in order to produce their climate risk assessments. So on to the next slide. What we have produced to help our analysts and our fund managers actually choose the best corporate bonds to invest in is we've created our prime, it's what we call our ESG ratings and our climate ratings, a climate evaluation model. And of course, when we were building it, we were looking at what are the best-in-class ways of evaluating climate risk for a business. And I know that you've had a few talks on this during the course of this conference today, but really it does break down into two different types of risk. The ability of a business to actually change, how it's running its business from the point of view of governance primarily, and of course physical risks. And I think the reason for doing two different ways of thinking about climate risk is because that some businesses are more impacted in one than the other. And so, if you're thinking about some businesses, naturally physical risks are going to be the ones that come to mind. Perhaps their businesses are located, at low-level areas or where they're vulnerable to things like forest fires. Other businesses, transition risk is actually much more of a factor for them. So you really need to be looking at both because they are going to be highlighting very different types of risk. From the point of view of thinking about our climate risk rating, we actually started using this rating system a few years ago, and it was a starting point for our credit analysts to be able to have a dialogue with companies. We needed to give them the data to be able to sit in front of a business and say, we're really uncomfortable with your governance structure or the amount of disclosure you're producing, for example, or could you talk to me about your operations in this particularly vulnerable physical area? So it was used as a way of focusing the engagement conversation. But what we realized is we actually needed to do more than that. We needed to actually look at all the various underlying inputs into these risks and produce scores. Ultimately, we're mapping a universe of almost 2,000 issuers. We're getting an enormous amount of data from all the various sources on the left-hand side of the slide here, and you will, of course, recognize some of these data providers' names. And then, of course, we are using scenario analysis in order to understand, ultimately, what sort of score each business should have. Very simply, we give each credit that we're investing in a score from 1 to 5, 1 being the most the safest from climate risk, or the greenest, if I can use that expression, and 5 being quite vulnerable. So that is giving our analysts and actually the portfolio managers a nice clear signal about how much risk is in the companies that they're buying. If we just drill down on the next slide into the transitional risk pillar, what we're doing is we're actually sitting down with companies and saying, okay, we want to understand exactly who in your business is involved in the leadership regarding dealing with climate risk. In other words, is it a main board director? And what is the oversight that's happening on that? We also want to understand what sort of targets they've adopted, how aggressive they are they achievable, and do they make sense for the business as a whole? Regulation is something that we're seeing increasingly creeping into almost every sector. So we really want to understand how the business is going to deal with that and what sort of disclosure they're able to provide. Is it scope 1 and 2, or are they also including scope 3? We're then, of course, thinking about the degree to which they're thinking about their supply chain, and of course, their end customers. So really, that's the transitional scores that we're applying. The second stage of the process on the next slide is thinking about the physical risks. And the physical risks are coming, of course, thinking about all the main physical risks, so flood, fire, and so on. Are they acute problems or are they chronic? And then how sensitive is a particular business to these types of risks? And of course, what's the probability? And as you can see, we're using a baseline scenario of essentially current, and that's 2020 as of when the model was constructed. And then we're looking forward to 2030 and 2050. We're using 6 different inputs for climate assessments in order to be able to assess the risks there. So really, the climate model is producing these prime scores, and that's enabling us to do some analysis on what that actually means in terms of running portfolios in real time. So in terms of moving on to the next slide, we really gave ourselves quite a good research project thinking about, can bond markets actually price sustainability risks accurately? And really, how much do these sustainability risks feed through to a business failing? Now, of course, there is data, not as much data as you would have if you were looking at something like credit ratings, for example, but increasingly we're getting pretty decent data sources. We had a look at the MSCI database and the ESG scores provided by MSCI. And what we essentially did is we had a look at the default frequency across a sort of 1 year and a 5-year period using these MSCI scores. And when we were looking at the worst in class on a quartile basis, we could see a very clear trend. Now, less noticeable over defaulting over a 1-year period, but when you looked over the full 5-year period, you could see a very clear trend that the worst in class ESG scores, according to MSCI, definitely had a higher probability of default. Now, for those of you who've looked into this, also the other thing you tend to notice is that companies who have poor climate and ESG scores also tend to have a poor credit rating as well. So those two things tend to come hand in hand. But definitely the ESG research supports that having a good score or even just an improving score can actually reduce the probability of default. If we move on to the next slide, the other thing that we can see is if you're just looking at ESG scores, and for this we were using Insight's ESG scores as well as MSCI, and looking back again over that 5-year period, default frequency rises if you have all three, E, S, and G, with poor scores, as opposed to only one of the E, S, and G poor, and so on. So essentially, these factors, these risk factors, E, S, and G, and actually as well as climate off by itself, are good indicators of whether a company is actually going to survive. In terms of what it costs, so on to the next slide, something that certainly we're seeing a lot in the UK, and I imagine it's similar conversations in the Netherlands and on the continent generally, is we want to implement some sustainability rules into our portfolio, perhaps have some specific climate rules, but how much is it going to cost me? Because of course, ultimately, these investment products need to be able to produce attractive returns. And so what we have looked at is, and we looked at 2 different periods of time. We looked at March 2020, because of course the world was crazy then, and we looked, more recently, 18 months on. We restricted the universe by worst in class, so the worst 50th percent of the universe were taken out by ESG rating and also by carbon. And what was really interesting to us, whether you looked at March 2020 at the beginning of the pandemic or now, actually you weren't seeing a big difference in the yields and spreads available at those periods. And also, we were looking at compared to the full benchmark. So in other words, you weren't taking anything out of that universe. So that was quite heartening, because I think when investors think, oh, if I start restricting and taking things out and doing best in class, that it's really going to hurt the yield or the spread that can be achievable. And of course, we did also look at our own Responsible Horizon Zero Corporate Bond Fund to compare and see what yields and spreads look like there too. And essentially, after doing this analysis, we have reassured ourselves that we don't have to compromise on yield or spread if you are trying to implement some best-in-class or sustainability rules in your portfolio. And that is really critically important for our client base, because they are really trying to do 2 things at once, i.e. do no harm, have a portfolio that has really good, attractive climate and ESG metrics, but also actually be able to produce an attractive return. I think the other thing to say about why spreads and yields aren't overly impacted is also because what you're seeing a lot of impact and green issuance from some of the sectors which we haven't seen before. So, for example, the energy sector has come out and is issuing quite a lot of impact bonds, which would have been a benefit. Also, some of the sectors which are worst in class don't tend to be the largest sectors as well. So you're still obviously getting plenty of financials, which clearly don't tend to have a poor carbon score. So if we look at sector risk on the next slide, we've also been asked about, well, the self-fulfilling prophecy idea that, certain sectors, because they're just so unloved from the point of view of the do no harm principle, have they been underperforming? And can we expect to see that in other sectors? And so, of course, the sector that is definitely the most controversial being tobacco, we have seen an absolutely clear trend of the tobacco sector underperforming, as you can see there, about 100 basis points relative to the overall market. And of course, that's really being driven by exclusions. But when you think about a sector where you haven't seen exclusions, And instead, the approach from investors has been more, I'm looking for utility companies which are evidencing a better transition, or indeed have a lower carbon intensity on the basis of investing in renewables. There's been an interesting shift there too, where the lower carbon intensity utilities actually have outperformed. You've seen the higher carbon intensities continuing to have a higher spread. So, we can definitely see that it's not the whole sector that's been hit, because that's not a sector that people would be looking to exclude, but you are seeing some differences in relative performance at the company level. The other thing in conversations with clients that we're having on the next slide is wanting to look at the carbon emissions by sector, and then really saying, okay, I can't exclude everything, because clearly I'm going to end up with a portfolio that's very, very undiversified and unbalanced. But how about if I look at just some of the sectors with the highest emissions? Is there any scope for adjusting the portfolio to have a better outcome? And for the most part, the sectors with the highest emissions are no surprise, I'm sure, to any of you. But what was interesting to us is something like communications, which you can see we've highlighted there in the orange box, where for some reason they seem to have a higher scope 2 emissions than some of the other sectors that are quite similar. And if we drill down on the next slide, what was interesting to us is that just like in any sector, there are those who produce, lower emissions or have better a better outcome when it comes to carbon than others in the sector. So there is an opportunity even in some of these, lower emitting sectors to pick a best-in-class issuer. And so what we noticed, you can see that for the most part, they're all around 30 or 35 when it comes to scope 2 carbon intensity, except for Telenor, which actually has a lot of operations in the emerging world where the energy that they use there is coal generated electricity, because that's the only thing that's available in the emerging markets, or some of the emerging markets that it is doing business in. So a fairly straightforward way of somebody who's feeling quite sensitive about their overall carbon score is to obviously focus on those issuers with a lower scope 2 emissions. On to impact bonds, page 14. And this really falls into the opportunity, because again, we're always talking about the risks and wanting to exclude and, screen, and it's always about taking things out, but what about adding things in? And so, of course, I'm sure you have all seen lots more impact bonds around, which has been tremendous, broadening out of the sector. We do still see that a lot of the U.S. issuers just don't have as good of frameworks as they do in Europe when it comes to these impact bonds. They don't often have formal KPIs. Some of them don't have a sort of a second opinion in terms of evaluating how good the framework is. So, they're getting there, but there is definitely still a divergence. We have seen an increased amount of sovereigns coming to the green bond market. And I know the previous speaker just mentioned green gilts, which is great. But the other thing is that we're seeing consumer cyclicals and some energy companies also issuing impact bonds, which has been really nice to see. So, it's not a case of you having to have a bunch of supranationals in your portfolio, which probably don't yield much. You're getting lots of different corporates. And of course, we have seen also an increase in things like sustainability and social bond issuance, whereas it used to be the sector was mostly dominated by green. You are now seeing some other types of issuing coming. After COVID, you saw quite a lot of social and sustainability bonds coming to market. In terms of opportunity as well, on slide 15, quite a few of our clients have been saying, well, I need to have government bonds. I'm not so sure I want green bonds because of the greenium, the premium you have to pay. But of course, there is opportunities for green bonds issued by sovereigns to get more expensive. And that's something that we've seen very specifically. We've seen it in Germany, but we've also seen it in the UK, where initially the green government bond comes at maybe a 1 or 2 BIP premium, and then ends up at a 6 or 7 BIP premium. So just because something comes more expensively, that's not a reason to ignore it. There is certainly an opportunity for those bonds to perform better. So in summary, I hope that what's come out of my talk, or from your perspective, has been that climate risk, certainly for our climate base, has been critically important to our clients. And we can see very clearly from my comments on the first slide that the emissions environment that we're facing is unfortunately going the wrong direction. So there is increasing urgency for our clients to be tackling this. In terms of buying climate risk off the shelf, we don't think that that's good enough. And frankly, you need to build your own tools, and hence we built our prime climate risk model. And the other thing that has come very clear to us is that climate risk is critically important for understanding default risk as well. And so doing this type of analysis, we think, will make it us better at avoiding problem credits. It is possible to build a portfolio without ending up with a very poor yield or spread. And in fact, therefore, you can produce good returns. And then finally, the impact bond market, as it broadens out, will continue to be more mainstream, and I think gives some interesting opportunities for clients to add value and add something back into portfolios, producing hopefully a more diversified outcome. Thank you very much.
Thank you very much, April, for your talk. We'll have a look if there's any questions from the audience. Zijn er nog mensen die iets te vragen hebben aan April LaRusse? We hebben ongeveer 5 minuten daarvoor. Ja, achter in de zaal.
What do you think pension funds should do and pension boards to do? What you propose in your talk, that we take more responsibility. You showed how you will do it on the part of investment management, but there's also a policy factor, of course. Have you ideas about that?
Oh, in terms of well, I can certainly comment on investment policies. In terms of regulation and what pension funds should do, I think the direction of travel, certainly in the UK, and we see it in other regulators around the world, is for pension schemes and other types of investors to be able to very clearly demonstrate what their climate objectives are and to report on it. So what we have been seeing from clients is they're wanting their portfolio to look acceptable from the point of view of carbon footprint, carbon intensity, the absolute carbon produced, and also to have a number of different scenarios. So what we're suggesting to clients is keep your investment portfolio as broad as possible, but ensure that your portfolio manager is giving you enough data to be able to demonstrate a good, clean bill of health from a climate perspective. Because the regulations from our perspective are all going in one direction. You are going to have to be able to report this type of information and probably show it over time how your portfolio is evolving. Because if they're putting increasing regulations on companies and banks and countries for that matter, it's certainly going to hit the investment markets. And there will be a requirement to show an evolution of your portfolio over time. So the portfolio manager basically needs to be able to build a portfolio that's going to help you demonstrate an improving climate outcome, if that makes sense. Sorry, I don't know if I've answered your question, but I hope I've given you something to think about.
Meer. Ja, dan komt de microfoon aan.
My question is about how you use your model in your investment process. Like, do you exclude firms like we saw Telenor there, which was scoring much worse than all the others? Do you exclude these companies anyway, or what's the weight of the sustainability profile in your investment process?
Okay. Let me just back up a little bit to answer the question. So, of course, we're doing all the normal credit analysis that you would expect. As part of that credit analysis, there is an ESG score as well. Again, 1 to 5, so nice and simple. And so the portfolio manager is given an insight credit rating, a valuation score as well, an ESG rating broken down by ES and G, Both of those have momentum scores as well. So is it an improving ESG score or an improving climate risk score or deteriorating? And then the portfolio manager makes an assessment. Now, this is assuming that the bond isn't a 5, okay? So if it's a 5 and you're in a sustainable fund, it's not allowed, okay? So worst in class would mean you're not allowed to invest in them for a sustainable fund. Obviously, if it's a non-sustainable fund, then there's a decision to be made. In other words, am I comfortable that this credit is actually improving? Is the momentum score positive? Is the engagement we're having with the company positive? And is there an opportunity to make money from buying a credit which is improving? If you're in a sustainable fund and it's a 5, you can't invest according to our investment process. Of course, if they are improving, they could be upgraded to a 4, and if the company is moving in the same direction. So it does have teeth. So in other words, if it's got a lot of risk, and that merits a 5, then in a sustainable fund you're not investing in it. And in a fund which isn't sustainable, it better be demonstrating that, first of all, you're being compensated for that risk, and secondly, the business is moving in the right direction to mitigate some of that risk.
All right.
Does that make sense?
All right, thank you very much, April. I'm sure there are many more questions to be asked. I had a few in mind, but this conference is running on a very tight schedule. So yes, we will have to move on here. Thank you very much again.
Thank you.